Hello, good people. I hope you're fine wherever you are. I am the Acca tutor, and I welcome you all to this week 6 lecture on cost of capital, capital structure 2, and business valuations. All right, in our previous lecture, we discussed the foundational aspects of capital structure, where we looked at two main things or areas, that is financial gearing as well as operational gearing. Okay, those are the aspects which we touched on when we looked at capital structure, and we said that capital structure is just the way or the nature of the mixture of capitals within an entity. Okay, that is the proportion of debt to equity or the proportion of equity to debt, something like that. That's capital structure in general. All right, but in this particular video, we are then going to go a step further into analyzing the theories behind the choice for the capital mixture. Okay, the choice behind, what drives financial managers to end up having a certain proportion of equity and debt. All right, that's the main focus of this video. Now, when it comes to the cost of capital, we will be looking at those costs related to capital that has been raised by the company. Remember, in our previous lecture, we looked at the sources of finance, sources of business finance. Okay, we also looked at this. Now, we then want to get a little bit deeper into the area of business finance, where we'll be looking at the cost of that finance, because we believe that finance is not going to come for free. It is paid for. Okay, so there is a cost that a company has to meet. Then lastly, we are going to conclude with business valuations, and then we call it a day. Now, cost of capital. Remember, we pointed out that these capitals are so many. They are in various forms. We have got equity. Okay, we have got preference shares. Okay, we have got debt, which could be long-term or interest-bearing debt, and then we can also have short-term debt. Okay, it could be long, it could be short-term. Okay, so in this particular video, we then have to look at the cost of each of these capital sources. All right. Now, what is cost of capital? All right, the cost of capital is the rate of return that the enterprise must pay to satisfy the providers of funds, and it reflects the riskiness of providing the funds. So from this definition, we can actually see that there are two main aspects related to the cost of capital. That it is the cost of funds that a company raises and uses, and then the return that the investors expect to be paid for putting funds into the company. So basically, we need to note that the cost of capital is not the cost of borrowing, although the cost of borrowing may be an element in the cost of capital. So when you hear the term cost of capital, this doesn't necessarily mean the interest on the loan. doesn't necessarily mean that it is the interest that is charged on the loan. It means a lot, although the interest component is usually incorporated whenever we are talking of the cost of capital. Now, the cost of debt, that is the rate a firm pays on its current loans, loan notes, and other debts, is likely to be lower than the cost of equity, the return paid to its shareholders. Okay, this is because debt is less risky for debt holders, from the debt holder's viewpoint. In the event of liquidation, the creditor hierarchy dictates that the priority of claims, the credit hierarchy dictates the priority of claims, and debt finance is paid off before equity. So this is why debt holders are the guys who have funded us. Okay, they're the funders, the guys from whom we have obtained the finance. So these are the debt holders. Then they are saying debt finance is not that risky, because should the company to which they have given the debt, should that company goes bankrupt, then they are the ones to be first considered for reimbursement. Okay, they're the ones who are at the top hierarchy. All right, they're the first ones to be reimbursed of whatever the company is owing or is owning. All right, so when the company goes into liquidation, the liquidators, what they do, they first pay creditors. All right, and then the owners of the company are then paid on the residues. All right, so debt holders are the ones who are given the priority. So this actually makes debt a safer investment than equity. So investors might actually prefer to be debt holders other than to be equity holders. All right, debt interest is also corporation tax deductible, unlike equity dividends, making it even cheaper to a tax-paying company. Arrangements costs are usually lower on debt finance than on equity finance, and once again, unlike equity arrangement costs, they are also tax deductible. So you can see that even in the eyes of the company that has taken the debt, debt finance is cheaper because it is tax deductible. All right, the interest charge, which those interest payments which are paid to debt holders, they are also tax deductible, which means in as much as we pay the debt, as much as we pay the interest on the debt, we are also going to enjoy the tax benefit associated with it, because by the end of the day, instead of paying a higher tax, the interest is actually going to reduce, because we are going to deduct the interest from the profits available. Then we will end up paying a lesser tax. Now, let's discuss about the risk and return. Okay, there is usually a trade-off between risk and return. Investors in riskier assets expect to be compensated for the risk. When you are talking of risk, ladies and gentlemen, we are actually referring to many things, but we know from our paper, performance management, where we discuss the notion of risk and uncertainty. It's just the same thing here. Okay, risk is something that is the chance that an event, favorable or unfavorable, is going to occur. All right, and in the context of financing, this is the occurrence, the potential that something bad can happen. All right, so if the potential is so high that something bad is going to happen, then the investors are actually going to expect a higher return. So that's the relationship. If the risk is high, then the return is also going to be high. Okay, the expected return is actually going to be high. So this is why we are saying the greater the risk of an investment, the greater the return would be demanded by the investor. You would expect a higher return. Okay, so you would demand a higher return in the end. All right, so the total return demanded by investor is actually dependent on two specific factors. The first one is the reward investors demand for the risk they take in advancing funds to the firm. This is the risk premium. And then the prevailing risk-free rate of return. So you can see that the concept of risk and return is actually enshrined in what we call the Capm formula. Okay, which says that return, okay, the expected return is equal to risk-free rate plus beta return on the market minus the risk-free rate. We'll talk much about this formula later on in the video, but this is actually what is being explained here, that whenever we are talking of the total return, this is the total return that is demanded by the investor, actually takes into consideration the risk-free rate, okay, of return. The risk-free rate is actually in the exam you might be given treasury bonds, treasury bills, okay, or rather bonds, okay, which are considered risk-free because they are bonds that are made or loans which are made to the government. All right, so it is generally believed that the government, when they borrow from you, okay, when they borrow from you, they are not going to go broke. They're not going to go bankrupt. A government cannot go bankrupt. So, so to loan a government usually is actually a risk-free investment. So the return expected on those treasury bonds, right, is actually the prevailing risk-free rate. So in the exam, when you're given the rate at which the treasury bills are going, then you then have to assume that that rate is going to be considered a risk-free rate of return. Then the the return on the market, that's the reward investors demand, all right, the rate at which investors are expecting to be paid on their investments. All right, so that one is actually called the risk on the market, okay, less the risk-free rate, which is actually going to be called the risk premium. After considering the risk-free rate, then that excess that remains is going to be called the risk premium, which put into consideration the expectations of investors vis-a-vis the risk-free rate. So that excess, the remaining excess, is actually going to be called the risk premium, and this one is then multiplied by the risk, the beta, all right, the risk measure. This one is actually a stock exchange metric, okay. This measures the stock exchange in general, the risk according to the portfolios listed on the stock exchange. So this is actually an average of all the risk put together. But in the exam, you're not required to determine the econometric part of it, the econometrics linked to the computation or the origination of a beta. You'll be given a beta usually, or some formula you're going to be given is actually going to be centered on on determining a beta, not from the scratch, but just making beta subject to the formula. Let's say you're given the variable for the return, Okay, in our Capm equation, you can be given in the equation the return, all right, and the risk-free rate you can be given, as well as the market premium you might be given, and they say determine the beta, all right. Of course, the examiner is not going to tell you that the risk-free rate is this one and this one in a straightforward way. You just have to lead yourself based on the principle, okay? Because you are only going to be told or to be given a scenario, and it is your duty to determine how you can get the beta. So the first place of call, or the first point of call, is that you need to have the formula at the back of your mind, or you need to actually know that the Capm formula exists, and then it also contains the beta value, and then you have to use the information given in the scenario to determine the beta. Other than that, you are not required to determine the formula for the establishment of the beta. Okay, you're not required to do that. All right. Okay, so we mustn't worry. All right, somebody might just out of interest, somebody might be worried as to how the beta should be computed from scratch. Okay, that one is a statistical process. All right, and usually the beta is equal to the covariance. Okay, covariance of the market or the portfolio, all right, versus the stock, all right, which could be X, all right, divided by the variance, okay, the variance of the stock in question, okay, or the security in question, which could actually be X, right? So the variance of X. But you're not required to do all these computations, because that's outside the remit of the Acca syllabus for now. All right, so do not worry much about these covariances and variances. They are outside our syllabus. All right, but when you are given the information in the scenario, then you need to determine or to understand that there is a Capm formula, and you'll be given this formula in the exam, so you do not have to worry much about that. Okay, let's move on and see what we can get. All right, let me just try to write this formula again. All right, beta is actually covariance on the returns, okay, of the portfolio, and then covariance of the returns of the portfolio and the returns of the stock. And I said this one could actually be X. You can just call it Rx, or over the variance of Rx, something like that, to be neater. But anyway, you are again not required to know this. All right, now the elements of cost of capital. All right, we have already discussed these ones, where we said that there is the risk-free rate of return, which has to be considered, and this is the return which would be required from an investment if it were completely free from risk. Typically, a risk-free yield is the yield on government securities, and then the premium, we talked about this one. This is the excess, or the increase in the required rate of return due to the existence of uncertainty about the future and about a firm's business prospects. The actual returns from an investment may not be as high as they are expected to be. Business risk will be higher for some firms than for others, and some types of project undertaken by a firm may be more risky than other types of project that it undertakes. So we know in the Capm formula that this is actually represented by the RM minus RF, but you need also to consider that this difference is explained in both the business risk as well as the financial risk that is attached to a particular stock, okay, to a particular stock or particular portfolio of assets. All right, so when you're talking of business risk, rather in simple terms, we are referring to the risks attached to the profitability of an undertaking. That's business risk. How variable are the profits? All right. Is the nature of the business going to allow it to be profitable, to be successful, and so forth? Its operations, are they profitable in general? Then when you're looking at financial risk, then this relates to the danger of high debt levels, that is high gearing. The higher the gearing of the company's capital structure, the greater will be the financial risk to ordinary shareholders, as this company would be committed to pay high interest payments, which would curtail its profitability by the end of the day. All right. So high gearing is actually going to be a burden at some point in time. Now, it doesn't mean that all the companies that are highly geared are likely going to fail. It doesn't work like that, because sometimes a company might be heavily geared, but its operations might be so profitable that the interest payments won't be anything significant to them. All right. So you need to make your judgments based on both these variables, the business risk and the financial risk, to see if by the end of the day the company is going to be affected by its capital structure. Okay, now let's discuss the various forms of long-term capital. Initially, we had pointed out that there is what is called equity finance, right? And on equity finance, I just want to point out, as I did in the previous video, that here we are looking at ordinary shares. And these include their nominal value, as well as the share premium. But we also have to look at what are called retained earnings. Okay, all these are forms of equity finance. All right, and then there are what are called preference shares. All right, these ones are usually considered debt because of the fixed interest. The fixed dividend part of it makes it a burden to the company. All right, if there is a fixed dividend attached, then they are actually a debt to the business. Then there is what is called debt, the mainstream debt, and we've got irredeemable debt. Okay, which means this debt is not going to be repaid. It is going to be in existence forever. All right. Then we've got what is called convertible debt. This one, the debt holder, okay, the debt holder has an option to convert the debt into shares. Okay, they may decide to just say we can we now need to be just your shareholders. So there is an option at the redemption date to convert the date into ordinary shares. All right. So depending on the attractiveness of the arrangement at that point in time. All right. And then there is redeemable debt. This one is ordinary debt, but it is debt for a specific period of time, after which the loan interest and the principal have to be repaid. Then a bank loan is a form of debt, but this one is of lower amounts. Okay, this is just an ordinary short-term loan that can be given by a bank. All right. Now, let's learn how to calculate the return. All right. Remember, we said that the higher the risk, the higher the return. So how do we determine the return which is expected by the investors? Okay. So for us to be able to calculate the return, we need to be based on certain assumptions. All right. So what normally assumed is that there is a perfect market that exists. So if a perfect market exists, then the market value of the investment, when you are talking of perfect market, we are simply saying there are no transaction costs, there are no transaction costs. Okay. Information is freely and readily available to investors. Funds can be easily obtained to pursue whatever project, okay, whatever project that is going to yield a positive NPV. You can just do everything, okay, at lower cost. There are no transaction costs, no taxation, okay, no tax to worry about. All right, so that's a perfect market. So in this type of market, the market value of an investment is equal to the present value of the expected future returns discounted at the investor's required rate of return. So this is the same as the investor's required rate of return is equal to the internal rate of return achieved by investing the current price and receiving the future expected returns. So this is actually what we are going to center on in most of our computations as we proceed deeper into the lecture. Now, the cost of equity. Let's start with the dividend valuation model. However, I have already indicated the first model which we need to be knowledgeable of. That is the Capm formula. This RE can also be called KE. That's the cost of equity, or the required rate of return by equity holders. Okay. Remember, the Capm formula is centered on equity holders because those are the ones who bear most of the risk. Okay. So their expected return is actually the standard, okay, the minimal mark that we need to consider if we are looking at the riskiness of an investment. So we look at the most affected guys, who are the equity holders, because in the hierarchy of when we are trying to assess, the hierarchy in case of liquidation, all right, the creditors hierarchy, remember, okay, we talked about that one, where we say that these guys, okay, the owners of the firm, Remember, they had loaned their money to the business. Okay, there are some form of debt holders, but special ones, because they have invested this money in the company, which is their own. Okay, so whatever happens to the company, they are the ones who are going to be repaid last. Okay, they are going to be repaid last. So in this case, they bear the most of the risk that is attached to the firm. So the Capm formula is another way of calculating the cost of equity, okay, the KE. Now, we also have this formula that is called the Dividend Valuation Model. So in the exam, do not, when the question says calculate the cost of equity, think of two things: the Dividend Valuation Model or the the Capm formula. Please think of these two. Of course, there are various ways, as you will see, which can be used to calculate the cost of equity, but these ones are actually the most standard ones. Now, the assumptions of the dividend valuation model. The DVM states that future income stream is the dividends paid out by the company. These are the future income streams which the equity holders or the shareholders are going to expect. That is the dividend income or the dividends which will be paid out by the company. Then the dividends will be paid in perpetuity. That's also another assumption, that the company is going to be there forever or for the foreseeable future, and the dividends will be paid in perpetuity. We are not expecting a stoppage in dividends in the company or from the company. Then dividends will be constant or growing at a fixed rate. So therefore, the share price is equal to dividends paid in perpetuity discounted at the shareholder's return. All right. So for example, if we are paying a dividend of $10, all right, and the cost of capital, or the required return is 12%, then the value, the share price or the value, the share price would be 10 over 0.2, and this shall give us how much? 10, let me see. I'm looking for the calculator. That's 10 over 0.12. So it means that the share price would be 83.33. So this is the market value of the share. So basically, assuming that the dividends would be constant, okay, then the formula for valuing shares would be PO is equal to D over RE, okay, where D is equal to the constant dividend from year 1 to infinity. That's the constant dividend from year 1 to infinity. All right. And then PO is the market value of the share price now. All right. And this is what we've just did in our previous example. And then the RE is the shareholders' required return expressed as a decimal. All right. So for a listed company, since the share price and dividend payments are known, the shareholders' required return can be found by rearranging the formula. So if you rearrange the formula, you can see that you end up having your RE as D over PO. So this is how you can calculate your KE. Note how the term RE, the shareholders' required return, and KE, the cost of equity, can be used interchangeably. Don't let this terminology put you off. So don't be confused with this terminology, the use of KE or RE, it doesn't matter. Now, Rubizai PLC has in issue $1 shares with a market value of $2.40 per share. A constant dividend of 30% per share has just been made or paid. The dividend has just been paid. What is the shareholders' required return? The shareholders' required return. So we know that KE is equal to D over PO. So the market value PO is this one, 240, and the dividend is 30 cents. So obviously, we know that D is the constant dividend from year to year, year one to infinity. So the dividend that has already been paid, that is not going to change. So this is 30 over 240. All right. You could use the decimal as well. The decimals were 0.3, because 30 cents is 0.3, okay, over 240. This is the same as 30 over 240, and which is equal to 12.5%. That's your KE. Now, assuming that the dividend is growing at a fixed rate, then, while in reality, dividends will vary year on year, a practical assumption is to assume a constant growth rate in perpetuity. So the share valuation formula then becomes modified to PO is equal to D0 1 plus G over RE minus G. All right, this is actually given in your exam. This formula, the DVM formula, is given in your exam. So don't worry, don't panic. But you just have to master it by head, because for speed considerations and so forth. So where G is the constant growth rate in dividends expressed as a decimal, and then dividend D1 is the dividend to be received in 1 year. So if you are given D0, that is the dividend that has just been paid, you then have to multiply it by 1 plus G, okay, to become D1. Okay, D0, that's the current dividend, multiplied by 1 plus G, it becomes D1, and the rest is as it is. Okay, so you can use again this formula to calculate your KE. Okay, and this, if you rearrange these figures, you end up having your RE is equal to D0 plus, multiplied by 1 plus G over PO. All right, D0 is equal to, RE is equal to D0 D1 plus G, D0 1 plus multiplied by 1 plus G over PO, which is equal to 1 D1 over PO plus G. All right, that is the issue. Okay, here I'm not happy with this one. It should be RE is equal to D0 1 plus G over PO plus G. All right, and this would then come to this final part. Okay, because we are saying D1 is equal to D0 1 plus G. So D1 is equal to D0 1 plus G. So in this case, this one is wrong, and we just have to work with that one. Let's look at this example and see if we can come up with some reasonable conclusions. Lacto PLC has in issue $1 shares with a market value of $3.60 per share. A dividend of 30 cents per share has just been paid. Dividends are growing at 8% per annum. What is Lacto's cost of equity? So we know that our KE is equal to D01 plus G over PO plus G, and this comes to D1 over PO plus G, and this comes to D1. We say that D1 is the current dividend, which is 30%, okay, 30 multiplied by 1 plus G, okay, the 1 plus G, and we are told that the dividends are growing at 8%, that's the G, so 1.08 over the share price, the market value of the share, which is 360, then plus 0.08, which is a G there. So this should give us some value, and this should be 17%. Okay, please cross-check with your calculators. All right, one thing, these share prices which we are using, they've got certain rules that apply to them. All right, in the exam, you might be confronted as to whether to use the cum-div share price or the ex-div share price. So you need to use the ex-div share price, which means use the share price after the dividend has been issued or has been paid. Okay, when you're talking of the cum-div, we are simply talking of the share price before the dividend has been paid. So cum-div share price minus the dividend due, we then have the ex-div share price. All right, so this is why we have to use the ex-div, because we want to, we believe that the dividend has got a signaling effect. Okay, it has got some impact on the pricing of shares which are being traded. So when a share is, when a dividend has been paid, the presumption is that there is going to be some movement on the share price related to that dividend. Okay, and I'm sure we discussed about those effects, the signaling effects of a dividend. We discussed them. Please replay the week 5 video to verify or to have a recap of that. Now, it will be noted that the share goes ex-div shortly before the dividend is paid. Any person acquiring the share after this point in time will not receive the dividend, which will be paid to the original shareholder. The reason is that the time it takes for the company to amend its register of members requires a cutoff point somewhat before the dividend is paid. Thus, when a share is quoted cum-div, the price includes both the underlying ex-div value of the share, that is PO, and the dividend due shortly. So what we need to use is actually the ex-div share price. Okay, let's have a go at this one. The current share price of Changazo Limited is 140 cents and a dividend of 8 cents is due to be paid shortly. Calculate the value of PO, the ex-div share price. So obviously we say that cum div share price minus dividend gives us the ex div price. So the cum div is 140 minus the dividend that is to be paid, okay, the dividend that is to be paid, and we have a 132 cents the share price. This is our share price after we pay the dividend. Okay, that is it. So this is the value you need to then put to your DVM when you compute your KE. You just have to use the X div price. Now we have been talking of of the growth rate. How do we determine the growth rate? Okay, so we need to look at that. But I think on these X div, this and that, I think we need to look at this example and see what is going on. Mombasa Coal is about to pay a dividend of 15 cents. Shareholders expect dividends to grow at 6% per annum. Mombasa Coal's current share price is $25. Calculate the cost of equity of Mombasa Coal. Okay, we know that the cost of equity RE is equal to DO 1 plus G over PO plus G. We know that. Okay, so since the dividend is about to be paid, the share price given must be cum div, right? So we are given this share price is actually cum div because the dividend has not been paid. So don't make a mistake of using that share price. So what is the X div share price? We need to use the X div. It's actually the X div is actually going to be 125. Remember, $25 is just 125 cents. All right, that's 125 cents minus the promised dividends, 15 cents, and we are looking at 110 cents. So this is the PO which we want. So we come here to this formula and say DO, okay, DO, the dividends, current dividends, all right, which is 15 cents, multiplied by 1 plus G, and G is 6%, so that's 1.06, over the PO. The PO is this one, 110 plus 0.06 our G, and we must get about 0.205, okay, which is equal to 20.5%. Okay, now without wasting much of our time, let us look at the estimation of the growth rate. The estimation of the growth rate. We have got two approaches which can be used to determine the growth rate of the dividend. That is, we can use the past dividends, okay, using past dividend. Okay, the rate at which the past dividends were growing, we can use that one, or we can use the RB model, sometimes called the Gordon's growth model, the RB. All right, so When you are using the past dividends, then you need to use this formula where G is equal to the nth root. The nth root in brackets DO over dividend n years ago minus 1, which can be simplified to DO over dividend n years ago to the power 1 over n minus 1. Okay, when we are talking of n, that's the number of years of dividend growth. Let's look at this example. A company currently pays a dividend of 32 cents. 5 years ago, the dividend was 20 cents. Estimate the annual growth rate in dividends. Now, in this case, this question is simplified. The examiner would have done it for us in determining the number of years. You will discover that there is still a challenge on establishing the number of years, as you will see in the coming example. Now, in this particular example, since the growth is assumed to be constant, okay, the growth rate G can be assumed to have been the same in each of the 5 years. So the 20 cents will have become 32 cents after 5 years of constant growth. That's the assumption. All right. So we are simply saying 20 cents multiplied by 1 plus G to the power 5 is equal to 32 cents. Okay. Or 1 plus G, okay, 1 plus G to the power 5 is equal to 32 cents over 20 cents. Remember, we have removed this 20 cents to this side, okay? So we just want to make G subject of the formula. Therefore, 1 plus G becomes, okay, 1 plus G becomes 32 over 20 to the power 1 over 5, okay, to the power 1 over 5. Please don't be confused or don't wonder where the 1 over 5 has come from. We have removed this 5 to this side. Okay, we have removed the power 5 to that side, so you can't remove it. You just have to multiply it by 1 over 5, so that the 5 cancels out. And you also multiply this side by 1 over 5. This is why we are seeing the 1 over 5 on that side. Just have to multiply both sides by 1 over 5 to the powers, remember. So this means G is equal to 32 over 20 to the power 1 over 5 minus 1. Why? Because we've removed this one, has been removed to the right side. Therefore, if you solve using your calculator, you will see that G is equal to 32 over 20, that's 160 to the power 1 over 5 minus 1. G is therefore 0.1, and G is equal to 10%. So simple, isn't it? That's the formula. Now let us look at the determination of years if we are given a data like this in the exam. It is now the year 2021 and Robust PLC has paid out the following total dividends in past years. So that's the dividend history given there. So how do we determine N? How do we determine N? Now, our N is going to be determined this way. From 2016 to 2017, that's 1. And here, that's 2. That's 3. That's 4. So our dividend has grown 4 times. So we come here and say 1 plus G is equal to root 4, the 4th root, 33,000 over 33,000 is the current dividend, and then 28,000 is the dividend n years ago, which is 4 years ago. So that's 28,000. Therefore, G becomes 4th root of 33,000 over 28,000. Okay. Minus 1. Remember, this minus 1 is not under this square root. Okay, it's outside. All right. So G obviously would be 0.042. Please practice punching these numbers in your calculators. If you just want to surprise the examiners, you will end up being surprised yourself. So practice before the exam day. Okay, now using the Gordon's growth rate, G is equal to BR. Now, before we go there, the assumption for this model is that the higher the level of retentions in a business, the higher the potential growth rate. So the formula is G is equal to BRE, and we know that the RE is that rate of return that the company can earn on reinvestment. Okay, the rate of return the company may earn on reinvestment is not necessarily the same RE which we have been calculating. It is not necessarily the same RE which we have been calculating. Okay, ladies and gentlemen, I need to emphasize this. This RE is not the usual RE so far. Okay, this RE is the accounting rate of return. Sometimes it is called the ROI. Sometimes it is called the ROS. Okay, this RE, don't confuse it with the RE you have been seeing so far. Are we together, ladies and gentlemen? So this RE actually gives the annual. This is the annual accounting profits. The accounting profits arising from an investment as a percentage of the investments made. So you can see that this is actually a ROS formula, okay, a return on capital employed. All right. So usually the formula for this RE or for the ARR, Okay, usually the ARR formula, remember I've specifically pointed out that this is the accounting rate of return. So this one is usually obtained by determining the average average profit per year, or annual profit, average annual profit over the cost of the investment, multiplied by 100%. So that's how you need to determine this RE. Don't think that that RE is the cost of capital. No, it doesn't work like that. Okay. Then B is equal to the earnings retention rate. That is the proportion of earnings retained in the company. The proportion of earnings retained in the company. All right. Okay, so now that being said, let us now look at this example. We are going to look at two examples as a minimum to see if we can say we are condensed. All right. Capm Rings Limited retains 40% of earnings each year and is able to reinvest so as to earn a return of 20% per annum. What is the expected growth rate in dividends? All right, so this company can retain 40% while it's, paying out. The rest, the 60% is actually paid out to dividends, but it can retain 40% of its profits. All right, so here we can use our G is equal to BR formula. That is G is equal to BR or RB. Okay, doesn't matter. Then this means that the R, okay, the R is 20%, that is 0.2, multiplied by the B, which is 40%, and we get our 0.08. Okay, which is about 8%. So the growth rate has been 8%. This is straightforward, given that the information so far was just simplified. The examiner would have been very generous to us, but it doesn't mean that this is always going to be the case. Sometimes the examiners are cruel people, not cruel actually, but they are very serious people who are determined to ensure that our day is ruined by the end of it. Now let's look at this example and see if we can as well manage to attempt it. So I want you guys to just pause the video and do the computation on your own, and then you come and do with me. Now, welcome back. Let us do it together. Zanele PLC has in issue $1 shares with a market value of $2.80 per share. A dividend of 20 cents per share has just been paid. Earnings per share were 32 cents. The company is able to invest so as to earn a return of 18% per annum. Estimate the rate of growth in dividends, then estimate the cost of equity. The reason why we put this requirement, we want you to appreciate that R is actually not the RE you have been looking for or you have been seeing so far. So please watch out there. Then C, estimate the market value per share in 2 years' time. All right, so let us determine our GRB. So our R, the R is given as 18%. Okay. Then the B, how do we determine the B? Okay, how do we determine the B in the question? Okay, actually, ladies and gentlemen, mathematically, you can see that the B can be easily determined. We know that the B is the proportion of the amount retained, okay, proportion or the retained proportion. So we were told that the earnings per share were 32 cents and the dividend was 12 cents. I mean 20 cents. Therefore, retained amount or retention, the retained earning was 12 cents. So we want the proportion of the proportion retained would be 12 over 32, which is equal to 37.5%. Now, with this information, we can then safely say AG is equal to RB, okay, which is equal to 18%, 0.18, multiplied by 0.375, and we get 6.75%. So this is the growth rate per year. Okay, now let us attempt part B. Part B, let me just space it here. Now, to estimate the cost of equity, given the information so far, we can easily say KE is equal to D1 over PO plus G. Okay, and our D1, that is the dividend now, which was 20 cents, 1 plus G. Our G, we have determined it to be 6.75, that's 1.0675. Okay, over PO, and our PO, that's 280 plus 0.0675, which is the growth rate. And if we punch these figures in our calculator, we must get an equal sign of, we must get the answer of 14.375%, which you can just round off to 2 decimal places as 14.38. 14.38%. That type of equal sign is an approximation. Okay, I'm trying to write an approximation. 14.38%. Please verify with your calculators. Now, we are required to estimate the market value per share in 2 years' time. All right, the market value. Now, in 2 years' time, we know that the current market value is $2.80. So in 2 years, this is an issue of simple compounding. So in 2 years, 2 years' time, this is equal to 280. All right, multiplied by 1 plus G. The G was 0.675 to the power 2, okay, because it's in 2 years, and this comes to $3.19. That's an issue of compounding. All right, all this said, what are the weaknesses of the DVM? The input data used may be inaccurate. Okay, the current market price, we do not know how true or how accurate is that price. And then the future dividend patterns, sometimes the growth rate could not be constant as we think. All right, so we are usually overusing assumptions. Okay, there are a lot of assumptions that are related to the use of the DVM. It also ignores the growth in earnings. All right, the rate at which the earnings are growing, it is ignored. So make sure you can challenge the assumptions of the DVM for an exam question. Do not leave the exam question blank. All right, so I think we have done much or justice to this part of the video, and we are going to continue in the next video where we'll be looking at the cost of debt. So far as the recap, we can calculate the cost of equity using two methods. That is, the first one, we use the Capm formula that says KE is equal to RF plus beta RM minus RF. And in the exam, please note that this bracket, the information in the bracket, can just be given as a risk premium. That's the risk premium. And you can just be given a single percentage. All right, do not be confused. The market risk premium. All right, this RM, this one is the return on market. Return on market. And this is the risk-free return. So the RF is the risk-free return. All right. Now the risk on the market minus the risk-free return, the risk-free rate, we get what is called the market risk premium. Okay, or the risk premium. Right. So this bracket can be represented by just one figure called the risk premium. Don't be confused. And then this is the Capm formula. Or you can also estimate KE using the dividend valuation model, okay, where we say that if the dividend is a constant one, then KE, KE would be D over PO. Okay, if it is a growing dividend, then KE, I know this machine of mine, when it starts to misbehave, you can't control it. We have got D1 over PO plus G, and we know that D1 is equal to DO1 plus G. Please do not be confused. Okay, these are the formulas which we have covered. This is the work which we have covered so far. We have managed to calculate the cost of equity, and it is determined in two formulas. We have also shown you that to calculate the growth in dividends, G can be found by RB or by past dividends method. The past dividend method, where we'll be using the some form of geometric mean. Okay, it is some form of geometric mean where we say that G is equal to d0 over dn, okay, to the power 1 over n minus 1. That's the formula where d0 is the current dividend and dn is the dividend n years ago to the power 1 over n minus 1. There's some form of geometric mean. All right, so far, ladies and gentlemen, I hope you are excited and continue to feel excited. Let me just say very, very excited. I am signing out. See you in the next video in our week 6 series. Thank you very much. Good day.